Good morning, this is Dave Toth with an RJO MRT Technical Webcast update on the S&P E-Mini, the Mini-Russell 2000, and 10-year T-note markets for Wednesday, November 30th. Starting off here with a 4-hourly chart of the December E-Mini contract, you can see today's clear and impulsive continuation of this week's earlier rebound that not only confirms at least the intermediate term trend is up, defining today's low at 1183 and Friday's low at 1147 as key recent corrective lows and risk parameters to all non-bearish decisions like short covers and cautious bullish punts. Not only does the market confirm at least the intermediate term trend is up, but by failing miserably to sustain losses below the early November support between 1208 and 1218, and by recovering above the November 18th 1230 corrective high that we have advised as a long-term risk parameter, the market has, moving to a daily log scale chart, the market has exposed the entire October-November relapse attempt from 1289 to 1147 as a three-wave and thus corrective sequence that would be consistent with a broader bullish count to eventual new highs above that 1289 key high from October 27th. The fact that this market rejected the exact 61.8% retrace at 1147 of October's rally from 1068 to 1289 reinforces such a broader bullish count. At this juncture, however, it's pivotally important that despite today's exuberance, the market continue to sustain impulsive behavior upward and reinforce a bullish count by in the form of three-wave corrective behavior on subsequent relapse attempts. The key to this is still reluctance to embrace a broader bullish count or to reestablish a broader bullish policy is the fact that on a weekly log scale chart, and again, despite the extent of this week's and the excitement of this week's recovery, the market still lies pretty much in the middle half of this year's broader range between May's 1373 high and October's 1068 low. Indeed, the market even remains below the recent October high at 1289. And as long as that retest, that 1289 retest of the May high remains intact, so does a long-term bearish count that suggests the October recovery is nothing but a right shoulder or a B or second wave corrective recovery within a larger degree peak and reversal threat that would further suggest that this week's recovery, again, despite its exuberant nature and its impulsiveness, is merely another corrective recovery within a broader developing bear trend. And herein lies the importance, getting back to an intraday chart, the vital importance of recent corrective lows at 1183 and especially 1147. For if the market is embarking on a resumption of the October rally and quite possibly the secular bull trend from the March 09 low at 666, it's absolutely imperative that this market continue to sustain trendy impulsive behavior up and relapse in three-wave labored corrective patterns. If the market cannot sustain recent gains above today's 1183 corrective low, it will, in fact, expose this recovery attempt as a steep but three-wave structure that would be consistent with a broader bearish count. These issues considered, traders have been advised to neutralize all bearish policies and exposures and move to a neutral sideline position for the time being. We believe that despite the extent of this week's recovery, current 1235 area prices make for a poor risk-reward ratio or condition from which to chase bullish exposure, given the key resistance between 1271 and 1289 above the market, but rather to wait for and require proof of three-wave labored bull flag type behavior on a subsequent relapse attempt to define a tighter risk parameter ahead of resumed gains that would reinforce that bullish count and provide a preferred risk-reward buying opportunity. For the time being, all traders are advised to just move to a neutral sideline position. Similarly, looking at a D Mini-Russell contract on a 4-hourly chart, you can see today's continuation of this week's developing recovery that confirms at least the intermediate term trend is up and defines today's 68.66 low as a short-term but very objective risk parameter. This market's now required to fail a blow to mitigate any broader bullish count, expose this recovery as a three-wave affair, and resurrect a broader move south. Looking at a daily log scale chart, you can see by virtue of the extent of this week's recovery and the market's failure to sustain losses below the early November low at 70.62, the market has rendered the November relapse attempt a three-wave sequence, left unaltered by new lows below Friday's 66.15 low. This three-wave sequence can be considered a corrective affair ahead of what should be a resumption of the October rally to potentially significant gains above October 27's 76.84 high. But again, the market needs to sustain impulsive behavior up and above recent corrective lows like 68.66. Moving to a daily linear scale close-only chart of the Mini-Russell, you can see this week's recovery from the exact 61.8% retrace of October's rally from 60.39 to 76.32. That would seem to reinforce a broader bullish count that contends that the November relapse attempt is bull market corrective ahead of resumption of the October rally. Moving to a long-term weekly log scale chart, however, you can see the market's position merely back to the middle area, almost exactly the middle of this year's broader range between 87.20 and 59.71. And from this long-term perspective, it arguably remains a coin flip as to this market's longer-term any kind of indication for a longer-term move. And indeed, as long as the market remains below that 76.84 high from late October, a broader bearish count that contends that this past May through October's sell-off is just the A or first wave of a larger degree reversal lower is still intact, with that recovery to 76.84 arguably the B or second wave, or right shoulder, if you will, of a broader peaking and reversal threat. Again, despite the extent and excitement of this week's recovery, it would be premature to dismiss such a broader bearish count. But at least for the time being, and from a short to intermediate term perspective, we can base non-bearish decisions like all short covers and cautious bullish punts on the definition of recent corrective lows and risk parameters at 68, 66, and 66.15. These issues considered, traders are advised to move to a neutral sideline position, taking defensive measures against all previously advised bearish exposure, but at current 72.69 area prices, we believe that this is a poor risk-reward condition from which to chase bullish exposure, preferring to wait for proof of labored corrective bull flag behavior to define a shorter-term and more practical yet objective risk parameter from which to base cautious bullish exposure. For the time being, however, a neutral sideline position is advised. Finally, moving to an intraday chart of the 10-year T-note market, you can see today's break below below Monday's 129.25 low. That confirms at least the short to intermediate term trend is down. The market has yet to break below the key 129.19.5 low from October 14th, but by virtue of today's break below 129.25, strength above today's 130.22.5 high is required to render the past week's relapse attempt a three-wave and thus corrective sequence. Until such strength above 130.23 is confirmed, at least the intermediate term trend is down, and we fully expect a break below that key 129.19 low that, moving to a daily chart here, would absolutely confirm a bearish divergence in momentum, exposing a much larger degree peak and reversal threat, at which point further losses and possibly accelerated losses, at least to the lower recesses of the past quarter's range down into a 127 handle, would be expected. You can see the market's rejection thus far of the extreme upper recesses of the past few months' range that contributes to a broader peaking and reversal threat. Moving to a daily close-only chart of the actual 10-year yield, you can see today's gains above the 201 corrective high from November 18th that confirms a bullish divergence in momentum, and the market is now flirting with that key 208 corrective high from November 8th. A close above that level would expose an area between 208 and 240 that is totally devoid of any technical levels of merit, and upon such proof of strength, we wouldn't want to underestimate the extent to which yields could rise immediately thereafter. These issues considered, traders are advised to move, shorter-term traders are advised to move to a cautiously bearish policy with strength above 130.23 required to mitigate that and warrant moving back to a neutral sideline position. Longer-term traders remain advised to maintain a bullish, albeit more conservative, bullish policy and exposure until the market fails below that 129.19 corrective low from mid-November. But again, it looks likely that that level is going to fail. Below that point, and again, moving back to a daily chart here, the market could collapse back to the lower recesses of this range, as again below 129.19 You can see there's virtually no levels of any technical merit between that 129.19 corrective low from a couple of weeks ago and the lower recesses of the past quarter's range around 127.06. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.